We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data.
I would say we have a 50% likelihood of a recession globally, but also in Europe.
I would expect a mild recession like 1990 or 2001, not a deep recession like 73, 74, or of course the great financial crisis.
It is going to be very challenging. It has been made significantly more challenging by the events of the last few months.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, standing in for Francine Lacqua. And here's what's coming up on today's programme. Jay Powell tells Congress a recession is possible as steep interest rate hikes will make a soft landing very challenging. He appears before lawmakers again today. Stocks and futures lose ground as growth fears mount, bunds rally, and the euro falls on the back of big misses on European PMIs. And Elon Musk says Tesla's new plants in Berlin and Austin are giant money furnaces, losing billions of dollars. That just days after clarifying to Bloomberg that he plans to cut 3.5% of its global workforce. Let's check in on the markets and bring you some breaking news. It's been a big day for breaking data. We've had misses when it comes to Eurozone, manufacturing and PMI data. Let's start with France and Germany. Those are both misses. In terms of the top line when it comes to the Eurozone, just bringing you the numbers then. Eurozone manufacturing for the month of June, 52. That's a big miss from the previous month, and it's a miss from the surveys as well. The expectations had been you'd get 53.8. The actual number across the Eurozone when it comes to manufacturing is 52, significantly down from the previous month as well. 54.6 was the number in May. So it's 52 for June, Eurozone manufacturing. When it comes to services, also a significant miss, 52.8. The surveys had seen 55.5. And we have another surprise in the central banking space. Norges Bank raising its benchmark interest rate to 1.25%. The estimates had been 1%. So it's a surprise move by Norges Bank in Norway. Again, as central banks reassess the impacts of inflation and the potential drag on growth. It's a surprise move by Norges Bank. And softer data, further soft data out of the Eurozone. We had Barclays earlier saying that the Eurozone now faces a perfect storm. We are joined now for analysis by Andrew Balls, CIO for Global Fixed Income at PIMCO. Also with us, our European economy reporter, Alexander Weber. Alexander, let's start with you on the data that we've had, the surprise move, I should say, out of the Norges Bank. A higher rate move out of Norway. What does that signal to you about concerns about inflation and how far and how hard these central banks need to go?
Well, so Norway hiked by 25 basis points. It's not as strong as the 50 basis points that the ECB is honing in on, and even further away from 75 basis points that the Fed hiked. It's the interest rate is a relatively effective tool in Norway, so it didn't have to go as far. But it shows clearly the determination by central banks to get inflation under control, even as growth concerns mount.
OK, so in fact, they did hike by 50 basis points. The rate came into 1.25%. The estimates had been for 1% in terms of rates out in Norges Bank. So it was a 50 basis point move. Andrew Balls, just great to have you on a morning full of data. And of course, that surprise move by the Central Bank of Norway. What is your assessment at this point, Andrew, of recession risks and whether central banks are going far enough and fast enough to address them?
So recession risks are very elevated. I'm not quite sure it's the 100% the baseline, but it's very high risk compared with normal times of recession in Europe, recession in the US. I don't think the central banks have got a great deal of choice. They need to tighten policy given where inflation is. This is something that we haven't seen for some time. In response to high food, high energy prices, central banks unable to look through it because the latest shock came, on top of already elevated inflation. In the U.S. case, I think it's quite likely you have a recession, given the extent of the inflation, the strength of the labour market. The Fed needs to slow the economy. Needs to get unemployment up in effect, and it's hard to do that and achieve the soft landing. On the European side, more of the inflation is from external factors. There's less in terms of excess demand growth in Europe, but it's certainly uncomfortable for the ECB, an inflation targeting central bank, to have inflation at these levels. Big constraint, of course, in Europe is the periphery, not only recession risks overall, but the sovereign-related risks, which complicates it further for them.
Well, indeed, and on that point, we're seeing significant moves into not just German bonds, but also Italian debt as well today. The Italian BTP yields down 11 basis points, currently at 3.43. German bond 10-year, 1.49, a 14 basis point move there. Is this just a significant risk-off move that we're seeing here in Europe, or is this a challenge to the ECB and the commitment to hikes in July and September?
So I personally think a lot is priced in for the ECB. The ECB didn't actually manage to hike rates in the last cycle. The economy's skirting close to recession, and there's less underlying inflation. So a lot is priced in for the ECB. So I'm not that surprised that we should see markets taking some of that back, just given the weakness of the data. Italy and the rest of the periphery is a concern. The ECB, is going to be hiking rates. They need to hike rates. The higher beta countries, it's not a great surprise that their spreads would have widened. And we have a big question now: can the ECB come up with something credible in terms of an anti-fragmentation tool? If you look at the history of the last 10 years, it normally takes several missteps before they come up with something credible. Credit where it's due, and they came out and announced their intentions to put something together. You've seen significant tightening of Italian spreads during, risk-off difficult markets. But with ECB, the politics is always so difficult. Will they be able to come up with something to maintain, good progress here, or will we have one step forward, two steps back, which again, looking backwards, has tended to be the way the ECB operates?
Yeah, indeed, the challenge of politics as the Eurozone, and in fact, the ECB tries to confront that fragmentation risk. Alex, let's bring you back in at this point. We were talking to Barclays earlier. They talked about this perfect storm for the Eurozone in terms of growth and inflation. There had been some assumption that, yes, OK, manufacturing in terms of PMI is going to soften, but services should kick back in as a leg of support. And we're not really seeing that. Do you have an explanation for why services are so soft in the Eurozone as the pandemic weakens and people try to get out and spend more?
In one word, it's inflation. It's demand has softened considerably for services, and according to the business service by S&P Global that were just published earlier this morning, it all comes down to cost increases. People are very concerned about the energy bills. They are seeing daily staples getting more expensive on a daily basis, and therefore they're cutting back on recreation. Tourism has stalled the momentum. We could see some of that come back over the summer, perhaps. The holiday season is just beginning here in Europe. But it's the surprise weakening of demand was all due to cost increases. We saw Germany trigger phase 2 of its emergency gas plan today, which just signals how much concern there is about energy supplies and rising costs on that front. And that's just something that households can't escape, so they're cutting back on other expenses.
OK, European economy reporter Alex Weber on the data we had out of the Eurozone, softer than expected. Andrew Balls, very pleased to say, from PIMCO, staying with us. We'll get more of his calls after the break. Just breaking live pictures now of the German economy minister. And of course, Alex was just talking about this, the challenge around gas and energy in Germany. This is the economy minister, of course, addressing those concerns, saying that Germany faces now an energy crisis. They are moving to phase 2 of their emergency gas plan. It is a 3-phase plan. Russia, of course, cutting gas significantly last week. And we know that Germany is trying to shore up its supplies, even moving to fire up coal-fired power stations. So this is Germany's economy minister addressing and giving a press conference there, saying Germany will activate additional coal-fired power stations. Again, pretty remarkable from a member of the Green Party. Coming up, we will be taking and talking US politics with Moelis Vice Chairman and former US House Majority Leader Eric Cantor. Do not miss that conversation. It's a little later in the show. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. OK, PIMCO says it sees an elevated risk of recession over the next 2 years. That is due to geopolitical instability, stubbornly high inflation and reduced household disposable income. It also says it sees positive returns on most bond benchmarks over the secular horizon. Andrew Balls from PIMCO is still with us. Andrew, you've talked about resilience, the need to build in resilience in an increasingly volatile era, an era and a time frame when there's going to be less fiscal impulse. How do you start to build that resilience in?
Well, firstly, I mean, I think you wouldn't be surprised, PIMCO, to say this, but we think that bonds have a key role to play in overall asset allocation. We've seen this, difficult period for all financial markets this year, but you now see bond yields at, pretty attractive levels compared with, the past several years. And given the extent of central bank hiking priced in, there's also the potential for bonds to not only provide the returns, but the protection in the event of recession. And we do think that recession, as we discussed previously, is quite elevated in terms of the risk in the US and in Europe. So better starting valuations amid what has been a difficult time in markets these past months, and the important protection in the event of downside risk, and then more broadly build resilience in terms of your asset allocation, your fixed income portfolio as well. Fairly cautious on credit. One thing which is going to happen is if we are going into recession, central banks are not going to be able to cut rates quickly. Fiscal policy probably is not going to provide a lot of support. So in contrast to the last 10 years where central banks were suppressing volatility, supporting asset markets, we think it's going to be a lot more difficult going forward.
OK, there's a lot to unpack there, Andrew, and it's great because we have no shortage of topics on which to focus. Is the 60-40 portfolio mix then back? And when it comes to, Andrew, when it comes to what you find attractive within the yield space, within the bond space, is it the short end that's looking more attractive? Just wondering if let's see if we still got you, Andrew, because sometimes we do have these tech difficulties on live TV. Andrew, can you hear me OK? Andrew, just checking you can hear me OK. OK, it seems we're having technical issues then with Andrew Balls, CIO for Global Fixed Income at PIMCO. Of course, their view, in fact, is that you could get to around 4% on the US 10-year. But as Andrew was saying, there are opportunities now, he sees, to add bonds, cautiously optimistic on things like credit as well. But they do, of course, and do say you need to build in resilience to your portfolios amid these higher recessionary risks. We will check in on the markets then, talking recessionary risks, becoming more pronounced, arguably, on the back of the data that we had, disappointing data out of the Eurozone. Manufacturing and services PMI for the Eurozone for the month of June coming in below the estimates. You've seen the euro pressured on this. Euro dollar currently trading at 105, down 0.5%. But really, it's the moves in the bond markets that have taken most of our attention. The German 10-year, you're seeing yields lower by 13 basis points, 1.5 on the German 10. The German 2-year currently lower by 14 basis points. I think we have re-established the connection with Andrew Balls. So let's bring Andrew back in at this point. Andrew, we were talking about resiliency in your portfolio markets and in your bond markets in terms of building out resiliency in these recessionary times. There's resilience as well from Andrew Balls in terms of reconnecting and coming back to us. Let me end with a final question. What are the biggest headwinds, potential headwinds, Andrew, in the second half of this year? The biggest tail risks?
Well, I think in the short term, it is the combination of high energy prices, demand destruction that's going to come from that, and I think that's part of the story you're seeing in the European PMIs. But central banks that are going to have to tighten policy, keep tightening policy, given inflation is too high and has been stubborn. And then beyond that, looking further out, I think a combination of central banks that can't ride to the rescue in the event of this recession. And then secondly, as we look out over the next several years, as a consequence not only of the prior COVID period, the prior China US trade wars, but now the Russia-Ukraine situation, a whole set of challenges where governments, companies are going to have to focus on building resilience in supply chains over maximizing efficiency in the medium-term implications. You know, your news today on Germany firing up the coal power stations, focuses on energy security, food security, on the government side. On the business side, robustness of supply chains, friend-shoring, near-shoring. These are things which over time are not going to contribute a lot to economic growth, but may contribute to the ongoing inflation pressures.
Okay, Andrew Balls, CIO for Global Fixed Income at PIMCO. We appreciate your insights. In terms of hedges, Andrew's calling for exposure to tips, commodities and real estate. Thank you, Andrew Balls. Right, coming up, the UK is a long way from reaching gender parity in the workplace. That is according to a report from the Chartered Management Institute. We get the details next. It is. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, standing in for Francine Lacqua. Now, the Chartered Management Institute's new report says that the UK would need, get this, 560,000 more female managers in order to achieve gender parity. We are joined now by Anthony Painter, Director of Policy and External Affairs at the Chartered Management Institute. Anthony, in fact, thank you for joining us. Give us a sense of the importance of this statistic and what it means about innovation and cost loss for businesses who are not propelling female employees to those management levels.
In short, it means a lot. And a lot of this debate has been driven by numbers, and we've put out some big numbers this morning around that gap. Over 500,000, as you said, Tom, rising to 800,000 by 2026, in fact. But why does it matter? Well, it matters because we know that businesses that have a properly inclusive culture, processes, organization are more profitable, more innovative, more productive, more successful, and countless studies have backed this up. And this research goes into the depth of those studies from McKinsey, from the OECD, from Boston Consulting. You can just reel them off. And this matters to businesses, and it matters to the economy at large.
Anthony, you talk in this report about the fact that a lot of companies talk the talk, but they just don't walk the walk when it comes to improving the opportunities and improving the gender balance. What are they missing out? What are companies not doing that they should be doing?
Well, for a start, not taking it seriously and getting complacent far too early. There's been improvements. There's no doubt about that over the last decade or so. We're seeing more women in senior leadership roles, for example. We're seeing a more ethnically balanced workforce. However, the progress has been incremental, and the congratulation has been large. And so the first thing they're not doing is facing up to the fact of how short we are. We don't have enough disabled people in organizations in managed leadership position. We haven't got enough ethnic balance. We haven't got enough people from socioeconomic backgrounds rising up the ranks of business and other organization. What should they be doing? They should be tracking it. They should be looking at the data. They should be setting action plans. Senior leaders should be showing leadership. They should be saying why this is important. It's not just a numbers game. This is actually about business success, about business sustainability. It's about us being successful in the future. All those things are absolutely necessary. And the businesses and other organizations that have taken those sorts of measures have seen gains.
Okay, so those are some of the concrete measures that could be put in place by companies. What about at the government level? What does the government need to be doing to lead by example on this?
We're seeing complacency in a lot of business, a lot of organizations. We're also seeing that same complacency in government. Government did some great things. You know, just a few years ago, the mandatory gender pay gap reporting measures, that seems to have made a difference, right? So it was making a lot of progress. It's fallen behind now. And actually, you know, we had a sort of advisory council. We looked into the research. We spoke to a lot of people. A constant message that kept kept on coming back during the course of this research is that government is now lagging rather than leading, and we need government to lead. We need government to explain why it's important. We need to be pushed sort of mandatory measures. We need government to use its purchasing power to emphasize the importance of inclusivity, because that will force business and other organizations to change as well, force public services to change. So we need government to show more leadership in this environment because of the wider economic benefits. And just think about it at the moment. We're talking about skills gaps, we're talking about record vacancies. What an opportunity to close those gaps.
Okay, great stuff. Anthony Painter, Director of Policy and External Affairs, on some of the key and concrete measures both companies and government can be putting in place to address the lack of balance when it comes to gender. Thank you for joining us. Coming up here to talk US politics, we are joined by Moelis Vice Chairman and former US House Majority Leader Eric Cantor. Stay with us for that important interview. This is Bloomberg. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London, and here are the top stories. Jay Powell tells Congress a recession is possible as steep interest rate hikes will make a soft landing very challenging. He appears before lawmakers again today. Sounding the alarm, Germany's Habeck triggers phase 2 of Berlin's emergency energy plan. The Greens leader warns the country is in the midst of a gas crisis. Stocks and futures lose ground. Bunds rally and the euro falls after big misses on European PMIs. Bridgewater Associates discloses a massive position against European stocks. So there's Ray Dalio making his move against European stocks. That weaker data, Barclays telling us the Eurozone now faces a perfect storm. French, German and Eurozone manufacturing and services PMI all coming in below the estimates. We now have the UK coming out with its manufacturing data for the month of June. 53.4 is the number for the month of June out of the UK when it comes to manufacturing PMI. For the context, it is a marginal miss from the forecasts of 53.6. Not significant, marginal. Services PMI unchanged at 53.4, the forecast was for 52.9. So UK services coming in slightly better than estimates, 53.4 versus the forecast of 52.9. Again, this is for the month of June. Manufacturing a little softer here in the UK, and of course how this feeds into the decision-making of the BOE, which is expected to hike again, and its next meeting is the expectation from the markets. Let's turn, though, from the UK and the Eurozone to what's happening in the US, and particularly politics and the inflation overlap. President Joe Biden has called on Congress to implement a summer gas tax holiday in response to soaring energy prices. It comes as the president reiterated that a US recession is not inevitable following a conversation with former Treasury Secretary Lawrence Larry Summers. My next guest is Eric Cantor, Vice Chairman of the investment bank Moelis, but also, Eric, of course, a Republican, served as US House Majority Leader from 2011 to 2014. And for much of his career in politics, he was the only Jewish Republican serving in Congress. Eric joins me now. Great to have you in the studio. And of course, we have to talk about inflation. We have to talk about what Joe Biden, the president, is doing to try and get gas prices at the pump in the US down. Let's start with the impact on the polling numbers for the US president as he faces up to the midterms of November. Before we unpack what's happening in the energy space, is it now a given that the Republicans take control?
Well, Tom, first of all, I would say this from the Biden administration's standpoint. I think that you could say figuratively and literally they're out of gas. And obviously, literally, we've seen the gas prices at the pump, which has prompted this administration to put forth the proposal yesterday for a gas tax holiday. But again, it's indicative of the fact that the administration is flailing. Even the Democrats on the Hill, Chuck Schumer and Nancy Pelosi, the leaders, have come out and criticized that proposal.
Would you back that proposal? Why does that not make sense?
No, it doesn't make sense at all. First of all, you can't guarantee that that's going to make its way to consumers. The way that the gas tax is levied in the U.S., it's not at the pump level. So it's at the import level or at the refinery level. So you don't know whether the consumer would ever even realize a benefit from that. Plus the fact that those revenues go into the Transportation Trust Fund. Anybody who follows that in the United States know that trust fund is underfunded, so you're just digging the hole deeper.
Okay,
there.
so they would say that the infrastructure plan is going to make up for that, but they would also push back and say, look, there are the geopolitical effects on the energy prices, and you mentioned refiners, that they're making a killing out of all of this. So to address those points, but also to say what policy reaction would be appropriate at this stage?
Well, at this stage, there's no question there are multiple crises that are impacting the American consumer and affecting business decision-making in the U.S. So right now, I would think priority one is to make sure that we unleash America's potential as far as the ability to produce more oil and gas. And as you may know, Tom, the politics in the U.S. on the left are just vehemently against the administration doing any of that. So you've never seen President Biden take to the podium in the White House and say, we're going to do everything we can in our power. We have the resources here in the United States to answer the call of the consumer and to bring those prices down. Just to give the market the signal, the administration is not going to stymie the permitting process and the ability for more production. And they just won't do that.
Well, again, they would point out that they have eased back on some of the permitting, and they've had a meeting this week with energy executives from some of the oil majors. They would say that they are trying to do their bit, but they would also point out that the energy majors are making an absolute killing in terms of profits.
All the while, exactly. All the while, all they can do is go in and blast. On the one hand, they're saying to the energy companies, do more. On the other hand, they're saying, you are raping the consumer, so therefore you are bad and we're going to tax you. The whole thing is just, again, that's why I go say the administration is just out of gas, literally and figuratively.
You could impose a tax on the energy majors, as they've done in the UK. That's a windfall tax.
How in the world would that help the consumer? I mean, right now you asked about politics and asked about Republicans and whether my party will win the midterms, and I would say today, absolutely, the Republicans will retake the majority in the House and will also in the Senate.
OK, that's the prediction for November, and many would agree with you on that front. We've got the congressional hearings around January the 6th that have been unfolding over the last few weeks, and it's a reminder of the inability for your party to detoxify themselves from a president, of course, who claimed falsely and lied about this, that the election was stolen. We know that's conclusive. Where is the Republican Party in terms of trying to detoxify themselves?
Well, first of all, I would say, Tom, I was unequivocal on the day that happened and shortly thereafter, publishing an op-ed opinion piece in the Washington Post just declaring that when you don't tell constituents and the voters the truth, this is what happens. And so I have no tolerance for any of that. But I would say in the end, these items the Democratic Party is trying to put on display, I think they pale in a comparison of what American families wake up to every morning when they think about what they're trying to do in terms of managing their family budget. When you've got inflation running over 8% in the United States, you've got gas prices way over $5 a gallon on average at home as well. So it unfortunate for the Democrats, fortunate for my party, but frankly, it's the American people that are losing because they can't quite keep up with the cost of living.
That is the here and now, and those pressures are real on households across the United States. But further forward, of course, the question of democracy, the very viability of US democracy. You've talked about the need to tell the truth, but the Republican Party is still backing a number of candidates, many candidates, up and down the ballot, who continue to spread the lie that this election was stolen.
Look, again, I don't condone any of that, and I would say the overwhelming majority of my party is not in that camp of telling the lie. Number two, I would say anybody who says that democracy is threatened and our institutions can't withstand the pressure, on that day, there was a binary choice. The institution rose to the occasion in Congress. The institution of the courts rose to the occasion and struck down and dismissed every attempt by the Trump campaign to make those challenges. And so I would say we have a problem, though, in actually the everyday functioning of the government. I do think you're going to see the Congress produce this this bill on gun safety right now, and whether you're for it or you're against it, it does indicate that there is an ability for the institution of Congress to work. Now, I would say, back to my point about the administration, it's not coming from the leadership in the White House, and that's really what the process in Washington is missing right now, is strong executive leadership.
And it looks like that bill could get through, which would be remarkable, as you say, historic in terms of gun rights. When it comes to, or in terms of putting in policies that may reduce some of these terrible shootings that we've seen across the US. But coming back to the question of Trump, does the Republican Republican Party need to move on from Trump? Or is he the most likely candidate still in 2024?
There's no question that Donald Trump is the most impactful force in the Republican Party today. He is the most coveted in terms of endorsement in the primary processes, and I do think that he is the front runner for sure for the nomination of our party if he wants to run.
And to be clear, you would support Trump in 2024 if that was the case, despite everything he's done.
I'm a Republican, and I've always supported the Republican candidate. And again, just with the discussion we've had, Tom, the policies that are underway in the Democratic Party being commandeered by the progressive left are not the policies that will ensure America continues to lead. So I could never support those policies, and I am a Republican.
It's just many people will look at that and say, OK, maybe the Democrats have gone too far to the left on some of these issues. But then you have the central question, again, of a president who tried to manipulate the outcome of an election in the most powerful democracy on this planet.
Again, I think what's most important to the American people right now is the ability for them to see a future for themselves and their family, and the ability for them to afford the cost of living right now and the cost of life. And right now they're having a real difficult time in undertaking that challenge.
OK, and that is the focus. Despite the fact that there are deep concerns, not just in the US, but outside the US. You must hear this all the time. And you kind of push back on that idea that democracy in the US is vulnerable at this point. But many outside and within the US are deeply concerned about this. And these are not people on the extremes.
Well, listen, I tell you, I'm concerned about the functioning of our government for sure, and I want to see it function. There is perpetual gridlock. That gridlock is reflective of the fact that the country is very divided and polarized politically. In the end, I think that greater forces will take over, and we're going to see a real potential for leadership again in Washington. Right now, we're just sort of reflecting what democracy produces, which is the polarization that is actually politically there across the country.
Well, there certainly is that polarization. Very pleased to say that Eric Cantor stays with us. We're going to talk about the markets, M&A, and where Eric is seeing opportunities, of course. Vice Chairman of the investment bank of Moelis and former US House Majority Leader, staying with us. Plenty more, of course, from Eric Cantor after the break. We'll talk as well about geopolitics, Ukraine, Russia, energy. Ukraine, by the way, taking one step closer to becoming a member of the European Union. We've got more on that story in a few minutes. Stay with us. This is Bloomberg. Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Eric Cantor, Vice Chairman of the investment bank Moelis and former, of course, US House Majority Leader, still with us. Very pleased to say. We were talking in the break about the geopolitics of Russia and Ukraine. Let's start with this. There has been some bipartisanship when it comes to how to address the challenge of Vladimir Putin and the war in Ukraine. Does that hold up, or are you starting to get a sense that maybe, amid all the inflationary challenges you were outlining for us before, that there is some sense of Ukraine fatigue set in within the body politic of the US?
Well, Tom, first I would say I think overwhelmingly the American people support the cause in Ukraine to stop an aggressive move by Vladimir Putin, just busting all international norms, invading a sovereign nation, and frankly, the absolute devastation he's caused to Ukraine. I think there is, yes, consensus in the United States that we support the Ukrainian people in their efforts. However, I do think in terms of issues that are priority around what we say the kitchen table, I don't necessarily think that the issue of Russia's invasion of Ukraine is number one anymore. I think much more so now, American consumers, families, individuals, businesses are much more focused on the economy. And frankly, from a consumer and individual standpoint, it is about that cost of life and cost of living if you think about gas prices and grocery prices. So I think going forward for this midterm election that we're going to see, that those issues, not Ukraine, will be more dominant.
And of course, it's those energy questions around higher prices, of course, whether it's oil or gas, not just feeding into the impact on households, but also part of the geopolitics and part of what we're seeing in terms of the attempts by central banks, the Fed, of course, to raise rates. Let's get there then in terms of what is happening. Second half, throw forward to the second half of this year in this higher rates environment, lower liquidity across the globe. What is M&A looking like? Which regions, which sectors most active? Is it starting to ebb?
Well, you know, at Moelis & Company, what we see with our clients, there's a lot of desire for dialogue around deals. There's no question about it. The thing that has occurred, though, over the last several months is the visibility toward completion has been somewhat diminished. And I think that is to be expected as we have all the uncertainty and clients are trying to navigate the prospects of continued inflation, the rise in interest rates, all the geopolitical concerns. So things are just taking longer. But I think our view from an M&A standpoint is, as you've seen the public markets essentially shut down in terms of the IPO market and the SPAC market, M&A becomes a real option for exit for many companies. And so we deal a lot, as you know, in the world of the financial sponsors. They have you know, a lot of capital. They definitely are being more savvy and cautious in these uncertain times, but their mandate is to transact. And so we see with all of the change that's occurring, all of these sort of crises that people are facing, that long term that bodes well for the M&A market.
And what are you seeing? Valuations tie into this. What are you seeing in terms of valuations?
Well, no question that we are trying to reach equilibrium, if you will, in terms of valuations in the private markets. As we know, the public markets have certainly, the valuations have come down. And that's all sort of some of the dynamic that is playing out in the minds of our clients at Moelis. But again, I think we take the view that with these times of change, adding to that technological disruption, which has not stopped, despite the valuations in the tech arena in the public markets, that will even spur strategics to want to think about where they want to position for the next 5 to 10 years. Ultimately, that will require them to transact.
Where are you seeing the most activity? In which sectors? Can you kind of unpack for us where that activity is most pronounced?
Well, for sure. I mean, obviously, in the energy sector, there's a lot of interest right now, which has been a real turnaround in terms of investor desire to even consider.
Is that interest back into carbon, or is it aligned with ESG? Because we've seen ESG under pressure as well.
Well, no, I would say in the U.S. there's a lot of interest in the private markets for sure to go back into some transition mode, which means natural gas. And part of the issue has been, back to my prior statements, that the signals from the government have been we don't want to see any long-term investment in fossil fuels past 10 years, which, you know, again, is stymieing the ability for us to do what we need to do to bring down fuel costs for the American people and, frankly, for global consumers. So I do think that sector for sure. You know, information services, we're sitting here at Bloomberg. I mean, that's certainly a sector that continues to develop and to accelerate. I mean, all sectors have had some impact given the macro environment, but I do think longer term, healthcare, there are other business services sector that our bankers at Moelis are very busy in terms of dialogue with clients.
Okay, Eric, we can't let you go without another question on politics, given your storied history and experience within the political realm of the United States. If the GOP win in 2024, if you have a Republican president back in that White House from 2024, would you consider a position if they reached out, tapped you on the shoulder, Eric?
You know, Tom, I've lived long enough and had a long political career, and now one with Moelis, that you know, I've learned to never say never. But I'm very, very privileged to be where I am. I'm enjoying the ability to see the world in terms of a financial lens and the ability for us globally to continue to help businesses to grow. And that's really where my lens was when I was in politics. I was a small business person and always believed very much in innovation and creating a platform for investors to create wealth, to create jobs.
You push with the Jobs Act. We know about that. That sounds like you're keeping the window open, you're keeping the door open. And I'm going to have you down as Treasury Secretary in that Republican administration. You wouldn't push back on that, I'm assuming.
So listen, I think there are a lot brighter people than I that probably would be first up for that job. But again, never say never in life.
There you go. Humility as well. Eric Cantor, thank you so much. Great analysis, great insights into what's happening, of course, within the domestic politics of the US, the geopolitics, and of course, M&A with Moelis. Eric Cantor, Vice Chairman of the investment bank that is Moelis, and former, of course, US House Majority Leader. Thank you for joining us on set. Coming up, Ukraine takes one step closer to becoming a member of the European Union. We've got more on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, European Union leaders are gathering in Brussels, where later today they are expected to grant candidate status to Ukraine and Moldova. The bloc will also discuss measures to combat the impact of Moscow's reduction of gas supplies to Western Europe. Germany's economy minister, Robert Habeck, called it an economic attack. And moments ago, Habeck triggered phase 2 of Berlin's emergency energy plan, putting the country one step closer to rationing. Yes, rationing of gas supplies. For more, we are joined by Bloomberg's Europe correspondent, Maria Tadeo. Maria, Germany really now sounding the alarm bells on this issue. Robert Habeck saying that he wants Europe to help with LNG deliveries. Will he get it?
Well, Tom, we're about to wait and see, but that language coming now from the economy minister in Germany now really sounding very, very concerned. And Tom, it really reflects some of the chatter here behind the scenes in the summit today. Real concerns are Russia, which, as you know, has been majorly reducing and limiting some of the gas supply to countries like Germany and Italy in the past 2 weeks, could really turn on the heat by potentially at one point cut it all together. And of course, the timing of this is particularly dangerous for Europe because storage is not full yet, and we're approaching what is the summer, of course, but this is all in preparation and with the view of winter. That is the most vulnerable time of the year for the European economy. A lot of them, of course, very dependent still on Russian gas. So this is a moment of a lot of concern here, a lot of worries about the implication for the European economy. And really, when you ask what is the solution, what is the plan, the issue here is that for the time being, they don't have one. So really, what a perfect storm is about to hit Europe.
There we go, the perfect storm. And of course, all of this linked to what is happening in Ukraine. And you could be seeing then an historic decision when it comes to Ukraine's candidacy for the EU, Maria.
Yeah, and Tom, this is now seen almost as a given, a done deal. All we're waiting for is now the formal confirmation of this candidacy status for Ukraine. This is clearly a political victory for President Zelensky. He said he wanted this. Ukraine campaigned on this for years, by the way, and this is a boost of morale for the country. But of course, we have to remind everyone watching this that this is a very long period. There's a big difference between being a candidate country to the EU and being a member of the European Union. And as you know, some countries get stuck in between for years. So over the short term, it is a win for Ukraine. But of course, on the longer period, it comes with a lot of challenges for the country.
OK, Bloomberg's Maria today on the ground watching, of course, as officials there meet to discuss that candidacy application by Ukraine. Historic, as Maria has outlined for us. And of course, the challenge and the rewriting of the energy complex across Europe. Germany taking that step to phase 2. Rationing now is potentially a prospect for the largest economy in Europe, which is quite remarkable when it comes to gas. In terms of the markets, you're seeing losses now of 1%. Still significant moves into German bonds. 19 basis point move. Look at that on German 10-year, now at 144 after that weaker than expected PMI and services data at the Eurozone. Plenty more coming up. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz in New York, Anna Edwards, of course, in London. Stay with us. This is Bloomberg.
For the last few years, the fundamentals have mattered less than things like momentum and investor enthusiasm.
I would say we have a 50% likelihood of a recession globally, but also in Europe.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data.
They're definitely going for a soft landing. It's just going to be almost impossible for them to pull it off.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 23rd. Our top stories today. Fed Chair Jerome Powell tells Congress that interest rate hikes could push the U.S. into recession, and a soft landing is very challenging. He'll testify in front of lawmakers once again today. The price of oil is falling again today as concerns over a slowdown increase. West Texas Intermediate is now down more than 15% in a little more than 2 weeks. Ukraine starts on the road to membership of the European Union. EU leaders meeting in Brussels plan to grant the country candidate status. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And you can't move for mentions of the R word, recession, Kailey, something that seems to be moving the markets at this time.
Yeah, it is recession fears that are so dominant in this market right now, Anna, and that was just reinforced by the commentary out of Jerome Powell on Capitol Hill yesterday. He says he doesn't think it's overly likely right now, but he can't rule it out. So that is something that the markets are grappling with. Certainly that was the case in Asia, though overall it was a more positive session. The MSCI Asia Pacific Index was up just a couple tenths of 1%, but you actually saw outperformance coming from China after Xi Jinping in remarks overnight talked about that 5.5% GDP growth target, reinforcing it, saying that China is going to have policies that support growth. So that gave a little bit of a sentiment lift there. And in Hong Kong, the sentiment lift came from the incoming chief executive, John Lee, saying that he's going to look at easing border controls. So that lifted stocks there by about 1.25%. Broadly, though, those recession fears really are at the forefront, and you see that reflected in the bid for safe haven assets, or at least perceived safe havens. That in yields coming lower really across the world, including in Australia, where the 10-year was down 13 basis points to just about 3.85%. And then the only currency stronger against the dollar today is the Japanese yen, a second day of strength coming off of the weakest level since 1998. Right now, dollar yen trading at 135.46.
Right at the weakest level that we saw in 1998. Kailey, the perceived safety of government debt, that's what we see investors looking for today in the U.S. 10-year. That's why we see yields right now at 309.63. Think about the fact that this is 40 basis points lower than we were just 2 weeks ago. We touched 350 in an intraday session. So the concerns are definitely about the R word, Anna, definitely about a recession. We only see S&P futures off about 0.1%. I thought it was really interesting this morning on Bloomberg Radio hearing you talk to George Buckley of Nomura. His bank thinks that we're going to see 5 consecutive quarters of contraction. That would be very bad news, obviously, for the economy and, of course, for oil demand as well. As a result, oil is down 2.33%, not just as a result of George Buckley's forecast, but just in general, the recession concerns around the globe. And then Bitcoin, normally acting, of course, in unison with S&P futures, normally very correlated with risk assets. But today, it's up 3.5%. Keep in mind, this is just the trade from midnight, and we're still holding at that sort of big round number at 20,000 right now, $20,575. Anna, what do you see in terms of Europe?
Yeah, we see that same risk aversion here then in markets, not as you were indicating in Bitcoin, but certainly in some of the other assets you went through. That search for the perceived haven of government debt, that continues to be the case here in Europe as well. So equity markets are weaker, down by 0.9% on the CAC 40, down more than 1% on the Xetra DAX. And this is almost across all sectors, and basic resources right at the heart of things. So that is one of the weakest performing sectors across Europe. And copper is continuing to get weaker from here. So we've seen a lot of weakness creeping into copper over recent weeks, and that has intensified as we've seen more mentions of recession. It seemed to be focused on Chinese growth concerns previously, and now morphing into a more global concern, in particular around the US, and also concern about energy transition, and maybe that weighs on copper as well, if that is to be delayed in any sense. These two assets both responding to the same story, and this is about the PMI story and how quickly that PMI, that measure of the economy in Europe, how quickly that is declining from here. We got PMIs out of Germany and out of France, and both of those came in, yes, indicating those economies are still growing, but they were rapidly declining, and they came in weaker than had been expected, much weaker than had been expected. George Buckley, Matt mentioned from Nomura, pointing me towards the new orders number in Germany, saying that signifies an economy that is slowing very quickly. So we keep, of course, the euro in focus as a result. That's down by 0.7%. Money going into the perceived safety of government debt, and we see the 5-year yield responding, we see the 10-year yield responding, and we're seeing some quite sizable moves in today's session. I put in natural gas as well because we are still monitoring, Kailey, what's going on in Germany. They've moved to this alarm stage of their gas management plan in relation to Russian input of gas into the German economy. The search is on for alternatives, of course, because everybody mindful of what could happen with those Russian gas taps as we head towards the winter. So a lot to think about when it comes to the energy picture here in Europe. More on that shortly.
Yeah, absolutely. We'll have more on that in just a minute. First, though, we want to run you through the events in the day ahead, including the summit of EU leaders that starts in Brussels. Ukraine's candidacy status will be high on the agenda. The Federal Reserve will also release minutes the results of its 2022 bank stress test. Then at 8:30 a.m. New York time, we'll be getting U.S. initial jobless claims and continuing claims. And finally, at 10 a.m. Eastern, day 2 of Jerome Powell testifying on the Hill, this time before lawmakers in the House Financial Services Committee, Matt.
All right, we will be watching that closely after yesterday, Jay Powell's most explicit acknowledgement yet that raising rates could lead to a recession. He told lawmakers that a recession is possible and achieving a soft landing will be very challenging.
It is our goal. It is going to be very challenging. It has been made significantly more challenging by the events of the last few months, thinking there of the war and commodities prices and further problems with supply chains. And the question of whether we're able to accomplish that is going to depend to some extent on factors that we don't control.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. to give us more of what we can expect from day 2 of Powell's testimony. Jack?
Well, first of all, you can tell that Powell is trying to thread a needle and acknowledge that there is a risk of a recession, but not say that it's inevitable and make it clear that he has a difficult job ahead of him. That would be a major focus for members of both parties, I think, especially Republicans trying to take the temperature on exactly how bad the situation is. One other interesting note from yesterday's hearing in the Senate that could transfer over to the House is a bit of pushback yesterday from Elizabeth Warren trying to make the case from the progressive side that raising interest rates does not take care of the specific supply side challenges that have played into inflation so far. It doesn't specifically lower gas prices or lower grocery prices. The House Financial Services Committee has some high-profile progressives as well, including Alexandria Ocasio-Cortez and Rashida Tlaib, a wide range of Democrats from them all the way over to Josh Gottheimer. So if there's some pushback from the progressive side along the lines of what we heard from Warren, that would be a major takeaway from today's hearing, and we'll kind of suss out the differing positions that Democrats have on whether they really want to push Powell on those interest rates.
And of course, we also heard some Democrats really pushing the corporate greed narrative when it comes to the reason for higher oil prices. And of course, President Biden yesterday tried to address that, calling on Congress to suspend the federal gasoline tax for 90 days. It's obviously largely a symbolic move, but just take a listen to what the president said yesterday.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along, every penny of this 18-cent reduction to the consumers. There's no time now for profiteering.
So, Jack, clearly this is a president that is running out of options as to how to address higher prices at the pump. Is this even a real option? Does this go anywhere in Congress?
The initial response to that was not particularly positive. Obviously, a lot of skepticism from Republicans, but even some key Democrats. There was a statement from Speaker Pelosi that essentially was a non-endorsement and kind of sidestepped the issue. But most interestingly, I thought, was Peter DeFazio, the chairman of the Transportation and Infrastructure Committee, who pointed out that this would ultimately take money away from the Highway Trust Fund. Lawmakers and President Biden tried so hard for that infrastructure bill that they got passed into law, and the idea that this would do more for individual consumers than it would to take away money from infrastructure projects is something that DeFazio and some other key Democrats may be skeptical of. So you're already seeing some pushback from Democrats who are allies of President Biden, let alone Republicans. So for now, there may be some support, especially from moderates who want to be seen doing something ahead of the midterms, but it doesn't exactly have a glide path forward, probably in either chamber.
All right, Jack Fitzpatrick of Bloomberg Government in D.C. And of course, we know that the price of oil doesn't purely determine the prices at the pump, and yet maybe some relief could be coming down the road as oil is resuming declines today amid increasing recession fears. Let's get more with Bloomberg's Danny Berger. So, Danny, it seems that the narrative firmly has moved to fears around supply to now fears around demand.
It's amazing how we just seem to be oscillating between these extremes, Kailey. That's right. It's no longer unabated inflation. It's now unabated recession. And you can look at what oil's done, falling some 11% since Friday. That's a pretty extreme move, given that the oil market is still very tight. We are still in an extreme, a super backwardation for this market. So it just shows how much of recession fears are filtering through the market. And there's really not a clear consensus on where oil goes from here. Goldman says, look, demand still outstrips supply because of that tightness in the market. The Fed, they can't print commodities. Cities say they expect oil to keep moving lower. But to be clear, it's not just oil. It is commodities across the board. And I know you flagged copper before at down 20% from its highs. And I have a chart. It's the classic kind of Dr. Copper chart that does show the gold to copper ratio. That symbolic move of what's happening in the economy is at its lowest since early 2021. So it does suggest that this move higher in yields, the move pricing in inflation, is starting to turn. Perhaps that has peaked out.
Yeah, and let me get to something else that's giving us a bit of a gloomy sentiment check on the global economy, and that's here in Europe. We've had the latest European PMI data, Danny, which paints a picture of economies slowing pretty quickly.
Yeah, 16-month low for that data coming in. S&P's global economist pointing out that the German economy, the German numbers, essentially losing all the momentum that they had built up coming out of the worst of the pandemic. So yeah, it's not just inflation fears in the U.S. They are really acute in Europe right now after this data. BlackRock's Rupert Harrison saying odds are on for recession in Europe. And likewise, we have seen the dramatic move in this European bond market. 10-year German bond yields, those on course to see their biggest drop since March. France also seeing a drop of 18 basis points as well. So it is a big push into bonds. And of course, the euro also reflecting that economic weakness. That is down about 0.6%, Matt.
All right, Danny, thanks very much. Danny Berger there talking to us about what's going on with European PMIs as well as oil and the energy picture. We'll stick with that right now because Germany elevated the risk level in its national gas emergency plan, raising it to the second highest alarm phase following steep cuts in supplies from Russia. Maria Tadeo, Bloomberg Europe correspondent, joins us now from Brussels for more. Maria?
Yes, Matt, very serious situation for Germany now. And the language coming out of the German economy minister, Mr. Habeck, today now sounding very concerned about possible supply issues when it comes to Russian gas. And Matt, the timing of this is no surprise because we've seen that Russia over the past 2 weeks has been limiting the number of supply or the amount of supply into countries like Germany and Italy. There is now a real concern that this is going to continue ahead of the winter months or that Russia could potentially cut it at one point altogether. Now, this is a time of the year in which European countries, of course, start to prep their storage for the winter. The winter is a time of the year in which European economies are incredibly vulnerable to any issues with Russian gas, some of them depending almost entirely on this. And it does show that for the European economy, this is a very serious situation. When you ask, and I've asked this repeatedly today, what is the plan if that was supposed to happen or if that were to happen? They don't have an answer for it. So this is really a perfect storm that's about to hit this economy.
Yeah, so do we get one step closer to rationing of gas supplies in Europe? Maria, you're gathered there, the international media we see gathered there for an EU leaders summit. This no doubt will get a mention, but also accession talks around Ukraine.
Yeah, and Anna, today European leaders are expected to give candidate status to the European Union to Ukraine. It is a political victory for President Zelensky. They had been campaigning for this for a long time. It's in their constitution, the fact that they want to one day join the European Union. I should note, however, for our international audience that there's a big difference between being a candidate to join the European Union and an actual member of the EU. Sometimes that transition can take years, but nonetheless, it is a boost of morale for Ukraine. It doesn't mean they're joining overnight, but nonetheless, as I say, it is a political victory for Ukraine as the war against Russia continues.
All right, Bloomberg's Maria Tadeo reporting from Brussels. Thank you so much. Now to another story that caught our eye this morning. Elon Musk said Tesla's new plants in Germany and Texas are losing billions of dollars as the company tries to ramp up production. Musk said in a video discussion filmed on May 31st that both the Berlin and Austin factories are, quote, gigantic money furnaces right now, offering insight into Tesla's operations in the days leading up to Musk's decision to cut costs by laying off employees. As for how that is translating into Tesla's stock in early hours, not too much reaction. The stock is actually higher by a little less than 1%. Another stock moving higher is Snowflake. The software company was raised to overweight over at JP Morgan. The analyst putting a $165 price target on the stock. Right now, it's trading at $132, up the better part of 4%. Finally, we were talking with Danny about the declines we are seeing in oil prices. No surprise that is weighing on big energy players in early hours, one of them being Chevron, which is down about 1.4% before the bell, Anna.
Things to watch then, Kailey. When we come back, we will talk to Marilyn Watson, BlackRock's head of a global fundamental fixed income strategy. Does she think that yields have peaked for this summer, for this year, even as recession fears maybe put a lid on those? And on crypto, we'll talk to Adam Dell, Domain Money's CEO. He's founded many businesses over the years. What excites him about crypto right now? Plus, Binance CEO CZ is following a path popular among tech disruptors. Ignore the demands of governments for as long as possible. Read more on today's Big Take story, Bloomberg.com, or by typing NI Big Take into your terminal. That's where you'll find it. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller in New York, with Kailey Leinz, Anna Edwards with us out of London. Now, I've been looking at a longer-term chart of oil because yesterday Jerome Powell and President Biden were blaming Putin for the rise in prices at the pump. So I thought, is that really the cause? Oil pre-pandemic was around $60 a barrel. And of course, it came down in the midst of the pandemic. Then we passed out $5 trillion to the American people, and it shot up to 90. That's a 50% increase before Vladimir Putin invaded Ukraine. Now it's at 103, so it's risen another 13, 14, 15% from then. But Eddie Vanderwalt joins us right now from Bloomberg Markets Live to talk about this. Eddie, I realize it's easy politically to blame Putin, but it could have been the fiscal stimulus that started the inflation issue.
Yeah, I would definitely look a lot closer to home if I was the Biden administration. I think, there's two issues that came about well before the war in Ukraine. One of them, of course, OPEC supply cuts. OPEC had a significant impact on the market, but far more significantly, we did not see shale production pick up. Right, when prices started to pick up. Last time prices were as high as they are. Now, the Baker Hughes oil rig index was sitting significantly higher than it is now. And the reason for that is they are worried politically. U.S. shale oil producers are worried that politically it's unpalatable. And when prices come down again, they will be forced, to pay higher taxes and all of these things. So they're not willing to make those long-term commitments to producing that you need to have a stable oil industry.
Yes, they've often called for a more stable investments environment, haven't they, Eddie? And no doubt some of that around shale drilling and also refining capacity will be in conversation today when it comes to that meeting between oil executives and the White House. Eddie, let me stick with commodities, but ask you about other commodities in focus. I mean, we were talking about iron ore just a day or so ago. We've been talking about copper this morning. It seems everywhere you look in commodities, there's another commodity that's losing faith in global growth.
Yeah, absolutely. Copper is another one. I think what we're seeing broadly is that, investors are worried about a recession. But at the same time, I think there's a little bit of basket selling of commodities. We had macro investors getting really behind the commodity rally. And now, they're starting to question that. So we're seeing some of that macro money pulling out of the space. And therefore, we're seeing broad space, everything in the BCom, just pulling back a little bit, with copper and oil, the biggest targets.
Eddie, thanks so much. Eddie van der Veld of the Bloomberg Markets Live team. Thank you very much for your thoughts on oil, copper and beyond. If you want more market analysis, check out MLIV Go. That is the function for the Markets Live blog on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fed Chair Jerome Powell tells Congress that interest rate hikes could push the U.S. into recession, and a soft landing is very challenging. He'll testify in front of lawmakers again today. The price of oil is falling again today as concerns over a slowdown increase. West Texas Intermediate is now down more than 15% in a little more than 2 weeks. And Ukraine starts on the road to membership of the European Union. EU leaders meeting in Brussels plan to grant the country candidate status. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And European stocks really feeling the pain of day after day, reflecting on the possibility of US recession, Matt.
Well, we're not anymore, Anna. I was actually kind of freaking out this morning listening to you on Bloomberg Radio talking with George Buckley at Nomura.
I'm sorry for that.
He's saying, you know, we could see 5 consecutive quarters of contraction. That's very bad, but futures are unchanged right now. In fact, you can see that they're just slightly in the green. So investors maybe not freaking out as much as me and George. I'm also looking at a 10-year yield that's come down a little right now, 3.1038. Over the last couple of weeks, though, it's come down pretty significantly from a 3.50 intraday high down 40 basis points to 3.10. So investors are buying that debt. NYMEX crude is also off pretty significantly, down another 2%. So we're at 103.97. Call it 104 a barrel for Texas Intermediate. Obviously, Brent, the global benchmark, up a little bit higher. But the concern is that if we have a recession, there will be less demand. It's no longer a supply side issue. It's now turned to a demand issue for NYMEX. And then Bitcoin, right now it's up 3.25%. I will caution that this number is just from midnight last night. So it's pretty arbitrary since Bitcoin, of course, trades 24/7, 365. Right now, it's still hovering around that big round $20,000 level at 20,501. Kailey, what do you see in terms of the pre-market movers?
Well, that move in Bitcoin may be arbitrary, but nonetheless, however Bitcoin is moving, that affects how crypto stocks are moving in pre-market trading. And they have all swung wildly with the swings in Bitcoin over recent days. Right now to the upside, Marathon Digital up about 3.7%. And for a stock like Coinbase, it was down 12% or up 12% on Tuesday, down 10% yesterday. Now in pre-market trading, it's up another 2.5% at the moment. But still, that's a stock that's lost about 3/4 of its value on a year-to-date basis. And of course, with the declines we were seeing in oil that Matt mentioned, you are seeing energy players under some pressure. Chevron and Exxon each down about 1.5%. And interestingly, Anna, I was looking at the sector performance within the S&P 500. Yes, energy is still far and away the best performer on a year-to-date basis, up something like 32%. In the month of June, it is the worst sector performer, down about 15% so far this month, Anna.
Yeah, and that takes us nicely into an update on what's going on here in Europe then, Kailey. European stocks still under pressure. So as Matt was pointing out, we're managing to at least flirt with the flat line over on the US futures picture. But here in Europe, we seem to be a little more firmly entrenched in the negative and down 0.7% off lows, off earlier lows. That's the best I can offer if you're looking for some for move higher here. This is the copper price. We've been talking a lot about oil. We've talked a lot about iron ore in recent days. And now we're talking about copper down by 1.9%. This is a continuation of a theme. There was a concern about Chinese growth. Now fears about a US recession and also the energy transition creeping into the conversation around copper as well. If there's any slowdown in that, and that may be debatable, but if there is, what does that do to copper demand? These two assets responding to the same thing, and this is concern about how quickly we're seeing slowing in the Eurozone economy. The PMIs today from France and from Germany, both pointing towards expansion, both still above 50, but they fell faster than anticipated, much weaker numbers than expected, and so the euro down by 0.6% against a dollar that, of course, is gaining ground because of that perceived haven status. And the German 5-year yield, I've got that in here as well. We're seeing demand for fixed income products of many varieties, and we see the yield then coming down by as much as 26 basis points on this particular 5-year contract then, Kailey.
Yeah, these moves are really incredible in the European bond market. The 10-year German bond yield just 2 days ago was trading at 177. Now we're down to 143 this morning, raising a question as the market shifts back its focus more toward growth and recession fears. Have we seen seen the peak in yields? Joining us now is Marilyn Watson, Global Head of Fundamental Fixed Income Strategy at BlackRock. Marilyn, have we?
I don't think that we have seen the peak in yields so far. I think what we're seeing now is the market continuing to readjust to the flow of information and the flow of data that's coming through at a very, very rapid pace. I think in Europe in particular, they really have been hit hard by a number of factors, not least they're coming out of COVID at the start of this year. Then obviously the Ukraine-Russia war has had a massive impact on the price in the Eurozone in particular, in terms of food, energy. They're also being very impacted by the shutdowns due to COVID in China. And a whole range of different factors, I think, are really weighing on the Eurozone and the overall sentiment as well. And I think that's a very important factor.
Marilyn, good morning. So
Morning.
you don't think then that all the fears that you set out there, they're not significant enough to sort of cap yields where we've got to at this point?
I don't think so, not at the moment, because I think also on the other side of that, we're seeing inflation that's still incredibly high, and some of those factors that continue to drive inflation, of course. And then from the ECB, I think they very clearly signalled that they intend to raise rates at the next meeting, about 25 basis points. They probably will, raise rates September, maybe December as well. I think the ECB also, with its emergency meeting last year, talking about some sort of anti-fragmentation tool. Yes. I think they're really doing everything they can to support the economy and support financial conditions as much as they can while continuing to normalise. So I don't think that we've necessarily seen the high yields.
Okay,
yet,
so you expect more rate hikes, and the market clearly expects more rate hikes on both sides of the Atlantic. I spoke to Stephen Major on an earlier programme on Bloomberg TV this morning of HSBC. He's a famed bond bull, of course. Yeah. But he was saying that he doesn't think that that we will see central banks globally tighten as much as is priced in. I mean, we were talking in particular about the Fed. Yeah. You could ask about the ECB, whether when central banks start to see the damage being done to economies by either other factors or by their tightening, that they will step back and not tighten some more. So as if this isn't like Volcker, they won't tighten as much as the market is pricing in to fight inflation. What's your view?
So I think it's too early to tell on what the peak in the interest rates will be. I think at the moment, both the ECB and the Fed as well, and the Bank of England are all clearly signalling that they need to tackle inflation, and they really want to help to bring that down. But I do think at the moment, as we mentioned, we really need to watch the economic data. When you look at the US, actually, the economy remains pretty robust. I know that we're having all these talks of recession and other things, and we are seeing financial conditions tighten. We're seeing slowdown in the housing market and other things, but you're continuing to see, business investment. The labour market remains very tight. Consumption is so far relatively holding up, although as we would expect coming out of sort of the post-COVID environment, we are seeing a shift from consumption of goods maybe more to services. But I think at the moment, the central banks are really trying to address concerns in the market about inflation, and then maybe once they've tightened a little bit more, both the ECB and the Fed, then I think we'll be much more in a sort of watch and see mode when we look at the data.
Marilyn, what do you like in terms of fixed income? I look at the indexes on the Bloomberg and just see these incredible year-to-date losses. If you're going to go bottom fishing here, do you go into sovereigns? Do you like corporates? Do you like high yield? Do you like Europe? Do you like EM? What do you like?
Well, actually, I think that's the million-dollar question, and I think you've actually hit the nail on the head. And then when you look at the overall returns year-to-date in a range of different asset classes, they're quite poor. But then I think that does lead to actually we see a lot of value, and we see a lot of opportunities now within fixed income. What we're seeing also is a dispersion. So when you actually look at it on a bottom-up perspective, we do like some sovereigns. We also do like some, investment grade and high yield corporates. When you look at the investment grade space, for example, I think in terms of carry to vol, we now see some very enticing opportunities, particularly at the front end of the curve. I think that we're finding a lot there in terms of carry and a risk reward scenario. I think also, but it's really about being really very conscious of the environment that we're in, and now looking at it from a bottom-up perspective. So in terms of alpha, I actually think we're looking at a very, very enticing opportunity set over the next 6 months and going forwards, because now we have seen this decompression in spreads. We're seeing much more dispersion in terms of different fundamentals of sovereigns and also corporates as well. So I actually think in this environment, for active investors, we're really, seeing some very good opportunities.
You mentioned carry. It makes me automatically think of the Bank of Japan. Can you fund everything by going short JGBs? I mean, are they just making it too easy, Marilyn?
I don't know that they're making it too easy, and I think that to fund everything, that route might be a little bit risky. We do at the moment have a small short duration position in JGBs, but I think we're also short duration in Germany at the moment and in the UK as well. So there are a lot of different funding scenarios, and and when you look at the Bank of Japan, they are obviously one of the last men standing in terms of central banks. We've seen the SMB move as well now. And I think, looking forward over the next 6 months, it will be very important to see what the Bank of Japan do. And if they do eventually change their yield curve control approach and they do change their policy, that's also going to have a significant impact on flows into everything from treasuries to investment grade. That the Japanese investors so far are trying to get yield outside of Japan.
Marilyn, thanks very much. Thanks for your time. Marilyn Watson of BlackRock here with us here in the London studio. A little bit of breaking news just coming through. Some red headlines across the Bloomberg tell me that Russia says it has paid coupons on the 2027 and 2047 Euro bonds in rubles. It will make the Eurobond payments in rubles under the new scheme. This, according to Russia, the Russian Finance Ministry putting out this statement today, and Russia saying it regards its coupon payment obligations as fulfilled. Coming up on the programme, we will get back to the crypto conversation. Adam Dell, Domain Money's CEO. What does the crypto winter mean to him? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, the president of Lithuania. That's at 6 a.m. in New York, 11 a.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, crypto stocks are rebounding alongside Bitcoin this morning as it hovers around $20,000. Joining us now is Adam Dell, Domain Money CEO. Adam, of course, left Marcus, the digital bank of Goldman Sachs, to start Domain Money. It has a number of crypto funds. Adam, what kind of questions are your investors in these funds asking you right now amid this crypto winter?
Yeah, we have a lot of customers who are obviously suffering through a very difficult market where volatility is impacting investors who are really in crypto for the short term. Our longer term investors understand the volatility in this market and appreciate that this asset class is quite nascent, and so volatility is to be expected.
So talk to us first about what you do at Domain Money. I mean, I think we're all pretty clear on Marcus, and you have founded a number of other businesses before you went to Goldman Sachs. What's Domain Money do?
Domain offers managed portfolios of different asset classes. We offer stock portfolios, we offer crypto portfolios, and we manage those on behalf of our customers.
So in terms of crypto, I always wonder what the institutional uptake is like. Are your investors mostly retail? Are you getting a lot of institutional interest? Have you seen a change in that?
Our investors are retail investors. We don't really serve the institutional market today.
What about institutional interest in, I mean, you're obviously in and around Wall Street. What do you think about the institutional interest? Is it going to stay amidst these huge drops that we've seen?
Yeah, I mean, the flow of funds into the digital asset class, has certainly taken a hit given the overall market environment. But institutional investors are absolutely moving into digital assets. If you look at the performance of, say, Bitcoin, for example, over the last 2 years, it's basically up more than 100% from July of 2020. If you compare that to, say, the Wisdom Tree Cloud ETF, which is down from $39 2 years ago to about $29 today, you can appreciate that while this asset class has taken a hit, particularly Bitcoin, there's some resiliency in the price of Bitcoin, which is really a proxy for the overall sentiment for the blockchain and crypto ecosystem.
Good to speak to you, Adam. Good morning. For institutional investors, what kind of question do you think they should be asking? Should they be asking which crypto asset is going to do best over a certain time horizon? Or should they be asking which industries are going to be transformed by the blockchain? What excites you the most?
Yeah, Anna, that's a great question and point. I mean, the reality is that, the blockchain ecosystem is made up of a collection of engineers that is really about 25,000 developers. If you compare that to, say, the Java developer community, which has about 7 million developers, you really get a picture for how early these technologies are. And because blockchains enable people to speculate, even at the earliest stages of projects, you see enormous inflows into the ecosystem, particularly during the period of real euphoria 8-10 months ago. And so, what we look at Domain is the core engineering efforts that are being built around useful things in our banking system: exchanges, settlement, audit, taxation. Those pieces are very, very early in terms of being built out by engineers. And so when we look at investment opportunities in this space, what we're looking at is software engineers building real valuable technologies that have a useful function in our economy.
Have a useful function in our economy, and maybe that takes on some of the critics who ask what is the utility sometimes of all of this. So you point to banking as an area that could be transformed by blockchain, Adam. Other sectors, are there other sectors that you think will really be transformed by this technology, taking a longer term view?
Yeah, well, certainly gaming is being transformed by blockchains. NFTs are an on-ramp for many consumers to use these technologies really for the first time. Most consumers really can't get their hands around assets like Polygon or Ethereum, but they do understand what an NFT is. And so that on-ramp into these technologies is really most being felt in the gaming world. This week in New York, it's NFT week in NYC. And what you see is a very vibrant community of people who really don't care what the price of Bitcoin is, but are interested in NFTs, interested in the technologies that allow participants in games to live anywhere, participate anywhere, and really define how games evolve, because it is a community-led effort to generate gaming activity rather than a centralized activity by an individual gaming developer company.
Adam, I'm fascinated by smart contracts and the idea, Mayor Eric Adams has said we could have birth certificates and property deeds and so many more important documents on the blockchain to cement that ownership or that validity. And then I wonder about proof of stake versus proof of work. I don't want to get too far into the weeds, but I have to say I'm skeptical as a journalist and as an enthusiast about proof of stake. How do you feel about these two systems of maintaining the blockchain?
Yeah, I mean, proof of stake is certainly a more energy efficient and scalable approach to consensus. And so it's very likely the future of how blockchains evolve. Proof of work consumes a fair bit of energy, isn't necessary to ensure validity and security. Now, while these technologies are nascent, nobody's found a more secure way to build a distributed ledger than a blockchain. What I'm encouraged by is if you go out into the developer community, the engineering community, startup community, and you look for teams that are working on, banking systems, distributed ledgers, gaming systems that are next generation, you'd be hard pressed to find an engineering team that isn't doing it on top of a blockchain. And that really tells you something, because it is the engineering effort that leads our technology forward, and they have voted with their feet.
Adam, great to get your take. Thanks so much for joining us this morning. Adam Dell there, the CEO of Domain Money, talking to us about the crypto universe. For more on the world of decentralized finance, the blockchain, and cryptocurrencies, tune into Bloomberg Crypto. It's Tuesdays at 1 p.m. New York time. Next week, we're going to speak with Troy Gajewski, Chief Market Strategist at FS Investments, as well as Mary Catherine Lader, the former BlackRock rising star who defected to the DeFi industry. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. And Tom, it seems that data out of the Eurozone adding to the sense that we find haven, or we seek haven in bond markets, and stocks have been selling off. That's been the story here in Europe anyway. I know you're also focused in Europe. You're thinking about inflation here.
I'm thinking about inflation as the overarching issue and the cultural aspects of inflation. I'm only doing this, Anna, for Matt Miller. I mean, he's so shocked by where BitDog is. We got to give him some love on his Germany. This is German inflation far back before the joining of East and West Germany. This is well back into the 1950s. And the massive success of the early 50s, 60s of Konrad Adenauer of controlling inflation off of World War II up to the shocks of an ascendant Deutsche Mark and inflation that was high, but not nearly as high as what Paul Volcker had to deal with in the late 70s in America. And then on down, Matt Miller, to the massive success of German disinflation for well over 10 years. And up we go. And the upper circle is where we are right now, just under 8%. That's unacceptable.
Yeah, it'll be so fascinating to see if Powell later is compared to Volcker, Moore, or Arthur Burns. Stephen Major this morning saying he thinks it's only going to be a couple of months. By the way, Tom, I used to go to meet with Dan Briette when he was in Berlin begging the Germans to take our LNG instead of using Russian gas. Now Amos Hochstein, I guess, will be part of the crew going to the Middle East to ask the Emirates and the Saudis to produce more?
Boy, have things changed. That's all there is to it. Price matters, and when price of hydrocarbons goes up, and particularly in Europe, where they call it the natural gas war off the war of Ukraine, there's a whole new dialogue. And we're learning about this every day, Matt, and very importantly, this is tentative, but very much scheduled in surveillance this morning. Maria Tadeo in conversation with the president of Lithuania, without question our most important conversation of the day.
All right, Tom, thanks very much. Tom Keene there, co-anchor of Bloomberg Surveillance. He'll be coming to you next with Lisa Abramowitz and Kailey Leinz. This is Bloomberg.